Welcome to another lecture on receivables. In this case, we're going to focus on notes receivable and how they are created and how they are different from accounts receivable. Our focus so far has been on accounts receivable, which is created when we have a credit sales. So let's take a look at a quick example and see what notes receivable are and how they're different. So here we have Moses Company that has the following transactions relating to notes receivable during the last 2 months of the year. The company does not make entries to accrue interest except at December 31st. So receivables that they have throughout the year, only at December 31st, they're going to make the entry for the interest accrual, not at the end of each month or quarter, but just at the end of the year. So we have notes on November 1st, we have loaned $60,000, and this is a 7% note. So we have loaned money to someone. The someone perhaps is our customer or our vendor, one of our business partners in the supply chain, up or down the supply chain. They have some cash flow problem. We are lending them money. Obviously, we are not in the business of lending money. If we are in the business of lending money, we are a financial institution. That's not who we are. So on this date, on November 1st, I'm going to have my first journal entry over here that I'm going to record. And it's notes receivable debit. And I'm going to credit cash because I gave out cash. And the terms of this note are 12-month, 7%. I need to know how long the note is for, so I know when the due date is and how much interest I need to charge from this customer. I need to collect from the customer. Then on December 11th, I sold goods to KR Pine, receiving $3,600 90-day 8% note. So it's not an accounts receivable, but it's a note. So perhaps my receivable terms are typically, let's say, for instance, 210 net 30. This customer wanted more time. I tell them, okay, I'll give you 90 days, but I'm going to charge you interest. So here we have a situation. We are at December 11th. Our journal entry is notes receivable debit, sales credit. This money is because of a sale. I will get I'm not giving cash right now. I'm giving my goods. So it's sales credit. My dollar amount is $3,600. I'm not doing the second journal entry we would normally do when we have a sale, when we sell goods, which is cost of goods sold debit, inventory credit, because that information is not provided to me. I will write down the terms of the note. The terms of the note are 90 days, 8% interest. The next transaction I have is on the 16th. I have received a $12,000 180-day note, 9%, to settle an open accounts receivable. So Murdoch Company owed me money, $12,000. It was due on December 16th. Obviously, they couldn't make the payment, so they're saying they need an extension. We're giving them a 180-day extension. But now what we're saying is we're going to charge you 9%. Remember, on accounts receivable, we typically do not charge interest. But on a notes receivable, we always charge interest because we're basically giving a more generous term over here. So notes receivable debit, accounts receivable credit, 12,000. The term is 180 days, 9%. So now if you will recap with the 3 journal entries, let's recap. In all 3 cases, notes receivable are debited. We created a notes receivable in our books. We created the asset in our books. We will get money in the future. What's different in each of these cases? In the first case, I gave cash to someone and they have to return the money. In the second case, I sold goods to the company and they have to pay me the money later on in 90 days. In the third case, this is for a past transaction. The customer is saying they want an extension. So I'm replacing the accounts receivable with a notes receivable. So we have 3 different ways in which we have notes receivable created in our books. Now we are down to the last day of the year, December 31st. And on this day, I'm going to do my journal entry, which is going to be interest receivable debit, interest revenue credit. On each of these notes, I have accrued interest, which means that interest is owed to me. Even if they pay me on December 31st, they will have to pay me interest. So let's see what that amount is and how I'm going to do the calculation. I've written down these terms over here to help me remember. In this case, I have the information right next to me, but even if you don't, you can work with what you have in your journal entry over here. So I'm going to go through the interest calculations for each of these notes. So for the first one, $60,000 is owed to me. The interest rate is 7%. It's a 2-month note. It's 2 months have passed. It's a 12-month note. November 1st through December 31st is 2 full months. Okay, so for this, what I need to do is I need to multiply it by a fraction, 2 over 12, in order to come up with the interest. So 60,000 times 7% times 2 over 12 will give me this number of $700. 60,000 times 7% times 2 over 12. The 2 is because it is 2 full months. Now let's see for the next one. This is 3,600. The interest rate is 8%, so I'll need to multiply by 8%. Now I need to multiply by a fraction. Okay, so this fraction, let's see what I have. 90-day note. How many days have passed from December 31st to from December 11th through December 31st? That's what I need over here in this calculation. So before I get to that calculation, let's look at the days. So I'm going to count from December 12th. We always start counting the date after the invoice. So December 12th through the 31st, both numbers being inclusive, you have 20 days. So it's a 90-day note. So the fraction I'm going to use over here is 90 over 360. It's a 90-day note. But how many days am I looking at over here? I'm looking at 20 over 90. Or you could just do 20 over 360. Whenever we have the term in days, we don't use 365, we use 360 in our calculations. That's only for our textbook exercises. In real life, they're going to use 365. So it's 20 over 360, or you could do 90 over 360 is the full interest multiplied by 20 over 90 because 20 days have passed. Now we use the exact same logic for the last note. We have $12,000, 9%. We have 180 days, so it's multiplied by 180 over 360 for the full interest, but the full period is obviously not passed. So how many days have passed? 16 through the 31st. We are looking at 15 days. It should actually be 17, not 16. That's my mistake there in what I wrote. 17 through the 31st is 15 days. Now, again, we do the calculation over here, and the extension is 15 over 180. That works out to 45. So when you add up the interest on the 3 notes, because we're doing only one journal entry, we have $761. That's the interest that has accrued. So I will do one journal entry. Now I could, if I wanted to, do 3 separate journal entries for $700, $16, and $45, but you'll do just one journal entry, a combined journal entry, because this is what's going into our income statement and our balance sheet. What goes into the income statement is a revenue. What goes into the balance sheet is interest receivable. What type of account is interest receivable? Obviously, it's an asset. You see the word receivable. It has a debit balance. It's a current asset because the due dates they're all within 1 year. So you'll get the money next year when the notes mature. So here are 3 different scenarios in which you have created a notes receivable in your books. Again, the major difference between accounts receivable and notes receivable is accounts receivable is always backed by a sales transaction, a credit sale transaction, and do not carry interest. Notes receivable could be backed by a variety of transactions, and they always include interest. So that's the major difference between these 2 receivables. Once again, this is another example of a receivable, a current asset. In this case, our focus was on calculating the interest revenue. In the last video, we'll talk about the accounts receivable ratios, the ratio analysis.